Welcome back to WealthWise, the podcast where clarity meets strategy. This week, we're peeling back the curtain on a massive economic move that's happening across the Atlantic, one that might be quietly reshaping your financial future no matter where you live. We're talking about Europe's high-stakes gamble, why they're slashing interest rates to save their economy. It sounds distant, but its shockwaves are global, and today, we're going to give you the playbook. You're going to learn 3 critical things. First, why the world's 2 biggest economic powers, the US and Europe, are playing a dangerous game of chicken with interest rates. Second, how a struggling European economy is creating both hidden risks and potentially once-in-a-generation opportunities for savvy investors. And finally, the single most important metric you need to watch right now that could signal what comes next. And to help us connect the dots, there's no one better. My guest today is Max Wise, a global macro strategist and a brilliant financial educator whose job is to find the signal in the noise of global markets. Max, welcome to WealthWise.
Sarah, it's great to be here. Thanks for having me.
It's our pleasure. Max, let's dive right in. I think for a lot of our listeners, especially those here in the States or elsewhere outside of Europe, a headline about the European Central Bank might get a quick glance and then a scroll. It feels abstract, like someone else's problem. Why is that a mistake? Why is this a global signal that we absolutely cannot afford to ignore?
You've hit on the most common and frankly the most dangerous misconception out there, Sarah. It's the "that's a them" problem mindset. But in today's interconnected world, there are no them problems anymore. What we're witnessing is a massive economic drama playing out in real time, and it has major implications for everyone. Picture this. You have the 2 largest, most sophisticated economies in the world, the US and the Eurozone. For the past few years, they've been walking roughly in step, both raising rates to fight inflation. Now they've reached a fork in the road. The European Central Bank, or ECB, has started aggressively cutting interest rates. They've done it 8 times in the last year. Meanwhile, the Federal Reserve here in the US is holding firm, hands in its pockets, worried that cutting rates too soon will reignite inflation. It's a historic divergence, 2 giants walking in opposite directions. And you have to ask why. The simple answer is that the European economy is getting a serious chill. The engine is sputtering. The reason the ECB is forced to act so decisively is because the economic data coming out of the continent is deeply concerning. Let me make it real for you. It's not just numbers on a spreadsheet. Think about a young couple in Berlin. A year ago, inflation was high. Their grocery bills were skyrocketing and their energy costs were a source of constant anxiety. Now, even though headline inflation has cooled, their wages haven't fully caught up. More importantly, their confidence is gone. So they're putting off buying that new Volkswagen. They're not renovating the kitchen. They're holding onto their cash because they're uncertain about the future. Now multiply that hesitation by millions of households across France, Spain, and Italy. That's what slows an entire continent to a crawl. And it's not just consumers. Think about the owner of a small manufacturing business in northern Italy. Her customers, like that couple in Berlin, aren't buying. So she can't justify investing in new machinery. She can't hire the extra person she needs. In fact, Germany, the industrial powerhouse of the whole continent, is officially in a recession. That's not just a statistic, that's millions of stories like these converging. So the ECB is essentially trying to perform CPR on the economy with these rate cuts. They're desperately trying to get money flowing and get people spending again. But here's the critical part for our listeners. When an economy the size of a continent makes a move this drastic, it doesn't just create ripples, it creates waves. And those waves, affecting currency values, trade flows, and investment sentiment, are heading straight for our shores. That's where things get really interesting, because inside those waves are both immense risks for the unprepared and incredible opportunities for those who understand what's happening. And that's exactly what we're going to break down next.
So, Max, you've painted this picture of a continent hitting the brakes. Let's go deeper. You said the ECB is performing CPR because the data is concerning. For our listeners, can you paint a picture of what that data actually looks like on the ground? Just how bad is it?
It's bleak, Sarah, and bleak isn't a word I use lightly in economics. The engine of Europe, Germany, which is the largest economy in the EU, is in a recession. It's not just slowing down, it's contracting. Its industrial sector, famous for its precision and efficiency, is struggling mightily. Then you look at its neighbors. The French economy is forecast to grow by a mere 0.6% in 2025. The Italian economy grew by just 0.3% in the first quarter of this year. To put that in perspective for our American listeners, even with all the talk of a slowdown here, the U.S. economy is projected to grow by around 2.5%. So many of Europe's largest nations are growing at a pace that's less than a quarter of that. It's near stagnation. But the why behind those numbers is where the real story is. It boils down to two critical, interconnected problems. First, as we touched on, is the crisis of consumer confidence. People just aren't spending money. The inflation wave of the past 2 years hit Europeans hard, but unlike in the US, their wage growth didn't keep up in the same way. So their real, take-home purchasing power was eroded. Now, even as inflation falls, the psychological scar remains. They're saving, not spending. That forces businesses to cut prices, which shrinks their profits, and the whole economy grinds to a halt.
So it's a confidence issue as much as a cash issue.
Exactly. And that leads directly to the second, and perhaps more alarming problem, stubbornly high unemployment, especially among the youth. This is where the numbers become genuinely shocking. In Spain, the youth unemployment rate is hovering around 27%. Think about that. More than 1 in 4 young people looking for a job can't find one. In Italy, it's over 19%. This isn't just an economic statistic, it's a social crisis in the making. You have a generation of educated, ambitious young people who can't get their careers started. They can't afford to move out, start families, or become the next wave of consumers the economy desperately needs.
And I imagine that just feeds back into the first problem. If young people aren't working, they certainly aren't spending.
Precisely. It's a dangerous feedback loop. People can't spend, so businesses can't grow. And because businesses can't grow, people lose their jobs. The ECB's rate cut is their attempt to throw a wrench in that machine and break the cycle.
Okay, so the diagnosis is a dangerous feedback loop. The ECB is now administering this strong medicine of rate cuts. Let's talk about the prescription. What specifically are they hoping this drug will do to the patient? And more importantly, what are the dangerous side effects?
That medical analogy is perfect, Sarah, because just like any powerful medicine, this comes with a long list of potential side effects. The ECB has 3 primary goals they want to achieve with these cuts. Goal number 1 is to make borrowing cheaper. This is the most direct effect. They want to lower the cost of a mortgage for a family in Lisbon or a car loan for a student in Paris. For businesses, they want to make it cheaper for that factory owner in Italy to borrow money to invest in new equipment and hopefully hire more people. It's Econ 101. Make money cheaper and people will theoretically borrow and spend more. Goal number 2 is to directly boost spending. This is linked to the first goal, but it's more about psychology. By signaling that they are on the side of growth, they hope to break that crisis of confidence we talked about. They want consumers to feel that the worst is over and that it's safe to start spending again. And goal number 3 is to boost the financial markets. When interest rates fall, safer investments like bonds become less attractive. This tends to push investors toward riskier assets like stocks. If the European stock market rallies, it creates what we call the wealth effect. People see their retirement or investment accounts go up in value, they feel wealthier, and they become more comfortable spending money in the real economy.
That all sounds good in theory. So what are the risks? What could go wrong?
This is the billion-dollar or rather trillion-euro question. The risks are substantial. First, there's the debt trap. Europe, both its governments and its consumers, is already sitting on a mountain of debt. Cutting rates to encourage more borrowing can feel like trying to solve an alcohol problem by offering cheaper beer. It might provide a short-term buzz, but it could lead to a much bigger debt crisis down the line if the underlying economic growth doesn't materialize. The second, and I believe biggest risk, is that it simply might not work. This gets back to consumer confidence. There's a famous economic saying, you can't push on a string. The central bank can lower the cost of a loan, but they can't force a nervous family to take one out. If people are worried about their jobs or the geopolitical situation, they'll save the money, no matter how cheap it is to borrow. And that brings us to the third risk, external shocks. Europe is far more exposed to geopolitical turmoil than the US. The war in Ukraine is on its doorstep, affecting energy prices and supply chains. Conflict in the Middle East has a direct impact on shipping routes. And then there's the uncertainty of global trade, especially with potential tariffs from the US after the election. A rate cut can't fix a supply chain disruption or a trade war. The biggest risk is the cutting rates is like trying to push on a string. You can make money cheaper, but you can't force a worried consumer to spend it. Confidence is the one thing a central bank can't print.
Okay, Max. This is the part everyone's been waiting for. We've diagnosed the problem in Europe. We've analyzed the medicine. Now let's connect all these global dots right back to our listener's wallet. Why should an investor in America, or an entrepreneur in Asia, or anyone outside of Europe be paying such close attention to this?
This is the most crucial takeaway. The reason this matters to everyone is that the global economy isn't a collection of separate swimming pools. It's one big ocean, and when you drop a boulder into one side, the waves are felt everywhere. There are 3 specific ways these waves will hit your shore. First is through trade. The European Union is the second largest economy in the world. It's a gigantic customer for the rest of the globe. In 2024 alone, the United States sold over $300 billion worth of goods and services to the EU. China sold over $500 billion. So when European consumers and businesses stop buying, it's not just a European problem. It directly hurts the bottom line of American companies. Think about Apple selling fewer iPhones in France, or American farmers selling less soybeans to Germany. The pain is exported globally. Second is through currency. This divergence in interest rate policy creates a tug-of-war between the US dollar and the euro. If the Fed keeps rates high while the ECB cuts, it tends to make the dollar stronger and the euro weaker. For an American tourist, that's great news. Your trip to Rome just got cheaper. But for a multinational US company like Ford or Coca-Cola, it's bad news. The cars or sodas they sell in Europe are priced in a weaker euro, and when they convert that revenue back to stronger dollars, their profits shrink. This can directly impact their stock price in your 401k.
So it affects everything from your vacation budget to your retirement account.
Absolutely. And that leads to the third and most actionable point for our listeners, investment opportunity. This is where risk and reward meet. The legendary investor Warren Buffett famously said to be fearful when others are greedy and greedy when others are fearful. Right now, sentiment toward Europe is deeply fearful. When an entire continent's economy is struggling, it can lead to situations where excellent, globally competitive companies think LVMH, a luxury goods powerhouse, or ASML, a critical technology company, get unfairly punished and their stocks become undervalued. For patient, long-term investors who do their homework, this period of pessimism could be a prime opportunity to buy into high-quality European assets at a discount. You can do this through ETFs that track European markets, or by carefully selecting individual stocks. Of course, and I have to say this is not financial advice, and investing in international markets carries its own unique risks. But the principle holds. Moments of maximum pessimism are often moments of maximum opportunity. In a flat world, no economy is an island. A cough in Frankfurt can and will lead to a shiver on Wall Street. The only question is whether you see that shiver as a risk to run from or an opportunity to embrace.
Max, this has been an incredible breakdown of the macro landscape. You connect these massive global forces to individual decisions so clearly. It makes me wonder about your own journey. You speak with such clarity now, but in a world this complex, learning often comes from mistakes. Was there a turning point in your own financial journey, a failure, a breakthrough, something that fundamentally and forever changed how you see the world?
Absolutely. And it's one of those lessons that you don't learn in a textbook. You learn it by getting punched in the gut, financially speaking.
For me, that moment was the Greek debt crisis, back around 2010. I was younger then, working as an analyst, and frankly, I was a classic case of what I call home country bias. I was sharp, I knew the U.S. markets inside and out, and I viewed the rest of the world through that very specific lens. When headlines about Greece started flashing across the screen, the consensus on Wall Street, and certainly in my own mind, was, it's Greece. It's a tiny economy, a rounding error on the global spreadsheet. How bad could it be? I had built a significant position for a client and for myself in what I thought was an ironclad, safe investment, a large, stable, Northern European bank. My thesis was simple. This bank had minimal direct exposure to Greek debt. It was German or French, I forget the exact one now, but it was one of the giants. It was insulated. It was safe.
A fortress, essentially.
Exactly, a fortress. And I watched the news about riots in Athens and thought, that's happening over there. And then the contagion started. It wasn't a slow leak, it was a wildfire. Suddenly, it didn't matter that my fortress bank had no direct Greek loans. The market stopped caring about fundamentals. It only cared about one thing: fear. The fear was that if Greece could default, maybe Portugal could too. If Portugal defaulted, what about Spain or Italy? Credit markets, the very plumbing of the financial system, started to freeze. The cost for banks to borrow from each other, even overnight, skyrocketed. And the stock price of my safe bank began to plummet. It was falling 5%, 10% a day. I remember staring at my screen, and my spreadsheet models were screaming that the stock was cheap, that it was a buy. But the real world was telling me a completely different story.
What did that feel like, that disconnect between your analysis and reality?
It was a profound sense of humility. It felt like I was a physicist who had just watched an apple fall up. Everything my models and my training told me was being violently contradicted by reality. The money lost was painful, of course, but the real blow was to my intellectual pride. I had been so sure, so analytical, and so wrong. That was my breakthrough. That was the week I realized that financial markets are not just about numbers. They are about narratives. They are about human emotion, scaled to a global level. I learned that contagion is not a financial term, it's a biological one. It's a virus of fear that respects no borders and no logic. That failure taught me the lesson that underpins everything we've talked about today. Capital has no passport, and neither does fear. You cannot understand what's happening in your own backyard if you refuse to look over the fence. It's what forced me to become a true macro-strategist, to see the entire world as one interconnected system.
That's such a powerful story, Max, and it perfectly sets up my next question. Given that lesson about an interconnected world, if you had to bet on one major shift that will define financial success over the next 3 to 5 years, what would it be?
If I had to place one bet, it would be on a trend that I call the Great Economic Divergence. For the better part of the last 2 decades, we've lived in an era of globalization where the saying, "a rising tide lifts all boats," was largely true. A boom in China lifted Germany, which lifted the US. But that era is over. What we're seeing now is the world fracturing into 3 distinct economic blocks, each running on a completely different operating system. You have the US block, driven by technological innovation, AI, and private sector disruption. It's dynamic, it's fast-moving, but it's also prone to bubbles and volatility. Its future will be written by companies in Silicon Valley and Austin. You have the China block, driven by top-down, state-mandated industrial policy. They're focused on strategic sectors like electric vehicles, renewable energy, and semiconductors. Their future will be dictated by 5-year plans from Beijing. And you have the European bloc, as we've discussed. It's driven by a delicate, complex dance of monetary policy and political navigation. They are trying to manage a mature, socially complex economy through the intricate tools of a central bank. For investors, this changes everything. The one-size-fits-all strategy is dead.
In the next 5 years, success won't come from just buying a generic global index fund. It will come from understanding which of these economic playbooks you are betting on. An investment in the NASDAQ is a bet on American innovation. An investment in a European financials ETF is a bet on the ECB's ability to successfully navigate this crisis. An investment in a Chinese EV company is a bet on the effectiveness of their industrial policy. These are 3 fundamentally different bets. So, the big shift is from a globalized, synchronized world to a multipolar, divergent one. Knowing which sea you're sailing in and what the local weather is will be the single most important factor for success.
The Great Economic Divergence. That's a framework that I think will stick with our audience for a long time. Max, this has been an absolute masterclass. Thank you for taking us from a single headline about the ECB and expanding it into a complete philosophy for navigating the new world we're in. As we wrap up, if you found value in today's deep dive, if you feel even a little bit more equipped to understand the world, we'd ask you to do 3 simple things. First, share this episode with one friend or colleague who you think needs to hear this perspective. Second, if you haven't already, please subscribe to WealthWise on whatever platform you're listening on. It's the best way to make sure you never miss these weekly breakthroughs. And finally, we'd love to hear from you. Leave a comment or a review and let us know. How is this global divergence affecting your own strategy or thinking? Thank you again for joining us. And always remember this: financial freedom isn't just about managing your own money. It's about understanding the global currents that are moving it.